SoFi has been having itself a pretty good year. The stock is up 72% year to date and over 126% since we last covered it back in April. Now, that's when I decided it was being undervalued, but in this video, we're gonna see if it still has the momentum to keep going further. So as a CPA, I'll break down the numbers so you don't have to. If you enjoyed the video, drop a thumbs up and subscribe to the channel, and with that, let's dive right in. SoFi achieved record adjusted net revenues of $858 million in Q2 2025. Now that's up 44% year over year, demonstrating strong top-line momentum across all business segments. This growth shows that SoFi's diversified model, combining lending, financial services, and technology, is scaling effectively without over-reliance on a single revenue stream. The lending segment contributed $447 million, up roughly 32% year over year, reflecting continued demand for personal, student, and home loans and healthy credit performance. The financial services segment more than doubled adjusted revenue to $363 million, driven by robust deposit growth, rising interchange fees, and the expansion of SoFi's money and credit card products. This surge is strategically important because it signals improving monetization per customer and successful cross-selling, both of which enhance customer lifetime value and reduce marketing costs over time. Now, the technology platform generated $110 million, up 15%, adding stability through recurring enterprise contracts. Fee-based revenue, up 72% to $378 million, is especially valuable since it diversifies SoFi's income and helps insulate performance from interest rate volatility. Now, profitability continued to accelerate, with adjusted EBITDA rising 81% to $249 million and margins expanding to approximately 29%, compared with 26% a year ago. This margin expansion indicates operating leverage. SoFi is turning incremental revenue into proportionally higher profits, a key marker of financial discipline and scalability. The financial services segment's contribution margin improved dramatically to 52%, up from 31%, illustrating that the company's investments in customer acquisition and product innovation are paying off. Rising contribution margins are critical because they show that SoFi can sustain growth while controlling variable and fixed costs. Now, strong credit performance and improved efficiency across product lines reduced risk-adjusted expense pressure, enabling more cash flow to be directed towards reinvestment, growth initiatives, and shareholder value creation. Now, based on these results, SoFi raised its 2025 full-year adjusted guidance, reflecting continued confidence in its growth trajectory. The company now expects adjusted net revenue of approximately $3.38 billion, up from prior guidance, and adjusted EBITDA of around $960 million, implying further margin expansion to nearly 28%. This guidance suggests sustained top-line growth alongside improving operational efficiency, a combination that typically supports valuation multiples and long-term equity value. Now, management's focus on expanding fee-based revenue and leveraging its technology platform positions SoFi to generate more consistent and higher quality earnings. With that said, let's dive into SoFi's current valuation. The first metric worth highlighting is the price-to-sales ratio, which currently sits around 10.51, roughly double its 5-year average of 5.12. In simple terms, for every dollar of revenue that SoFi generates, the market is valuing it at $10.51 in market cap. While that might sound rich at first glance, context matters, especially when you look at peers. For example, Robinhood trades at a price-to-sales ratio north of 32, which makes SoFi's multiple appear relatively modest given both companies are still in hyper-growth mode and rapidly scaling their user bases and product ecosystems. Now, looking at a profitability-based valuation, that also tells a similar story. SoFi's trailing PE ratio of 56.16 compares favorably to Robinhood's 65.94, suggesting that while SoFi trades at a premium relative to the broader financial sector, it still offers compelling relative value within the fintech space. The key difference lies in SoFi's trajectory, consistent profitability, expanding margins, and a more diversified business model. From that perspective, SoFi's valuation premium isn't excessive. Rather, it reflects investor confidence in its ability to sustain high growth while converting that growth into real earnings power. Next, let's look at the price-to-book ratio, which measures how much investors are willing to pay for each dollar of the company's net assets. SoFi's price-to-book ratio sits at 4.64, meaning it trades at about 4.6 times its book value. That's higher than traditional banks like JP Morgan or Wells Fargo, would usually trade around 1 to 2 times, but for a high growth fintech with strong return potential, it's a fair premium. It reflects confidence in SoFi's ability to keep growing book value through profitable lending and scaling technology operations. Now, in comparison, Robinhood's price to book ratio is 14.3, more than triple SoFi's multiple. That suggests investors are paying a much steeper price for future growth that's still uncertain. SoFi, on the other hand, looks more balanced, priced above banks because of its growth profile, but well below the more speculative fintech names. Overall, this implies SoFi's valuation still leaves room for upside as it compounds profitability and builds tangible equity value over time. So friends, if you enjoyed the video, drop a thumbs up and subscribe to the channel. Let me know your thoughts on SoFi in the comments below, and as always, thanks for watching. I'll see you in the next one.